Welcome, guys. So this is a really exciting session. And when we were actually doing our prep call, we were discussing how so many of these sorts of panels focus only on thought leadership and fairly immature use cases for stablecoins. But before us, we've got four individuals who are at the forefront of a maturing landscape where they're solving real problems for institutional customers. So I'm really excited to welcome Luke Dorney at LMAX, Jazz Shah, he's an independent consultant, Andrew Rossman at Ripple Prime, and Harpal Sandhu at Integral. So the first question to my panel is about how institutions are thinking about going from sort of pilot use cases to more mature applications and flows, and what frictions might come up and what the opportunities are in terms of infrastructure. So I'll go to Luke first.
Yeah, thank you for having us. It's a really interesting discussion here around stablecoins. So, if you think about the infrastructure for stablecoins, it's still kind of really in its infancy, and a lot of firms are still looking at this from a new technology perspective. And a lot of those models are in pilot mode, which have been built in very small and contained risk committees that have basically allowed firms to launch products to get access to stables in a very confined space. The way that we think about the infrastructure is split into three different layers. So you have the stable coins themselves. That I'd see those as the bottom layer. They are the kind of the issuers of the stable coin. Think of Tether, Circle, Ripple. The second layer is actually where those stable coins live, and are essentially the settlement rails, and that's the blockchain. Think, Ethereum, Tron, Solana. And then the third piece, which is where I think most of the challenges are for regulated firms kind of getting into this space, is really the top layer, which is the connectors to the blockchains and to the stablecoins, and that is exchanges, PSBs, wallets, custodians. And the biggest challenge for risk committees and regulated and audited firms getting into this space and kind of having approvals to move through that is really understanding that top layer and making sure that they understand the risks associated with connecting to these chains. Two things I think are really important around that is kind of the settlement piece, and that's you know stablecoins brings with it a view that it's going to create instant settlement, and that's instant settlement on chain. The reality of that at the moment, and where kind of some of the infrastructure breaks, is that a lot of those firms on the top layer all operate a little bit differently, and that sometimes means that that instant settlement doesn't occur because one custodian may operate a little bit different to another custodian, and they may not have that infrastructure in place to facilitate that quick movement. So, like, in summary, I would say the challenges around those risk committees really are applied to that top layer, and there's still a lot of challenges around that infrastructure.
Okay, and so sort of leading on from that, really. Harpal, in the summer, you guys launched Prime One, and I'm curious what you're seeing from your customers in terms of opportunities and frictions that have come out of the launch.
Right. Thanks. So to put my answer in context, Integral is a pure technology company, and we've been around for a while, and we've rode a couple of these very interesting disruptions in markets when new technology gets introduced. Stablecoins and tokenization of fiat currencies is one of those classic fundamental disruptions. And so, what do I mean by that? And I'm going to get to why why clients look at it in a particular way. Stablecoins done right essentially move the cost of transmitting money and to zero, and the time to move money to zero. So when friction like that goes to zero, entrepreneurs enter markets and experiment with different ways of solving problems without a historical constraint. usually what happens is the technology incubates for a long time, many years. It kind of sits underneath the surface until some interesting entrepreneur comes up with an idea that fundamentally changes how customers do something. So in Silicon Valley terms, it's quicker, better, cheaper in some fundamental way. We all saw this with AI recently, that Google and various firms were using machine learning and AI for 20 years now. But the moment OpenAI rolled out an AI with a natural language model on top of it, suddenly it changed everyone's perspective of how AI would be used. And in technology in the Valley, we refer to that event of someone coming up with something that that lights up the aha moment for the customer as a killer app. Okay, we call it a killer app because it's an application of the technology that people relate to, that people fall in love with, and then it draws the technology all the way in. So stablecoins or tokenization actually has been around for a long time. Every single one of our businesses here that trade FX have tokenized that FX in your software systems for the last 25 years. It just wasn't on chain, on a public ledger that other people could see, that you could then interoperate with other firms. So now that this particular tokenization of fiat is actually coming into market, it's a really interesting sort of event that has happened. So for us, what we did is we looked at it and we said, what are some of the hardest problems that people are dealing with, particularly in the crypto markets? And is there a way that if you had free instant transmission of money, that you could fundamentally solve some problems? So the place that we applied it to was credit intermediation. We don't call it prime brokerage, but essentially the ability to borrow a credit facility to trade against, or use temporarily a credit facility to trade with other folks. And so what we did was we solved a problem of variation margin. We actually tokenized US dollars, put it on chain, allowed people to open positions with each other on a network, and move the variation margin in real time as the value of those open positions move up and down. And so in doing so, at any point in time, in fact, we do this every single minute using stablecoins, every single open position of every market position, of every market participant is marked to market, and no one has any exposure to any other counterpart. So in removing counterparty credit risk, we've essentially created a credit facility where we no longer care about the balance sheet of the other market participant. So there's AML KYC. Other than that, you can open leverage positions, you can trade with folks, and settlement is sort of guaranteed because any change in outstanding P&L was already moved. That is one example of what we consider a killer app, that if it can bring people massive value, quicker, faster, cheaper, they'll use it, and the technology kind of gets drawn in with it.
One aspect I wanted to ask you, Andrew, is the challenges about moving crypto assets cross-venue, traditional frictions and what's different now. And I know you guys have literally just launched a really amazing prime brokerage solution, and you've got your RLUSD. Can you explain?
Yeah, I'll probably start by looking at the foreign exchange market, if you'll indulge me for a minute. So in the late 1990s, before the advent of things like FX prime brokerage and CLS came online, you had a lot of similar challenges. You had a fragmentation of liquidity. You had a lot of bilateral counterparty credit risk, or Herstat risk, as we call it in FX, and a lack of capital efficiency. There were a few bespoke deals, but nothing of industrial scale. So this meant that institutional capital sat on the sidelines. Sounds a little bit like the digital asset ecosystem as we see it today. Now, technology, to agree with Harpal, this is, and blockchain technology in particular, can remove this friction. You can get better, faster, cheaper on chain. And what we've seen from our perspective as Ripple Prime is practical applications of stablecoins today. We support moving billions of dollars each day from exchange to exchange, including the likes of LMAX, who are up here on the panel. We have one of the fastest growing OTC networks that involves stablecoins in multiple different uses, powered with partners of ours like Crossover Markets, one of the ECNs that we're a credit provider to. Our business runs 24/7. And if you look at on the traditional market side of things as well, we are the first prime broker to straddle between the digital world and the traditional finance world. We are one of the newest FCM GCMs on the CME. We're the only FCM that accepts digital assets as good collateral, which enables people to move it to us, obviously real time without the friction that Harpal was referring to. And then we can margin finance dollars to meet CME span margin. So in today's world, these are the sort of challenges that Ripple Prime is solving for.
Amazing. And Jazz, so I wanted to talk to you kind of one layer below this into the messier sort of infrastructure of settlements and maybe into the world of payments as well. So sort of frictions and opportunities you're seeing in the infrastructure side of things.
Yeah, I can actually coming here reminded me that, not that I forgot, but I worked for Citibank for 6 years, and then I did a stint at Schroders shortly after that. And what kind of triggered the relevance of this conversation is that post 2008, there was a big review of the CDS market. CDSs, non-standard CDSs, were seen as one of the reasons that the crash occurred. And so there's this huge initiative in the US and UK and Europe to standardize CDS contracts. The three of those benefits were increased liquidity, more transparency, and basically greater settlement. Three of the, I guess you'd say, pros for stablecoin. And so I worked on two of those projects, one at Citibank, one at Schroders. And I think in terms of the challenges for financial institutes, you would think that it would be technology, pure legacy tech, but actually internal financial institute technology is quite malleable because you have full control over, things like, I don't know, decision-making platforms, how risk calcs work in models. You have some sense of control. And just to use the analogy of the projects, the challenges I face in those projects that were very similar, the big friction points and the big tension came when we were looking at like accounting book of record, investment book of record, the systems that were kind of at the heart of those organizations, but there was almost cross usage across companies. So like SimCorp Dimensional did the accounting for some of our organizations. And that's where the big challenges will come over the next few years when people are trying to operationalize stablecoin flows. Is not trying to onboard into their internal tech and their, I don't know, trader facing organizations or internal treasury. It'll be, what are the products that are actually not directly in your control that you need to change, but actually rely on a third party timelines, third party dependencies, resourcing costs. That's one of the big challenges. I think the other big challenge that I faced in those two quite big projects is that, fortunately, because it was a regulatory led project, lots of the mandate came top down. So it was look, everyone has to do this thing. Everyone on the whole street is doing it, so you have to do it, and there's a deadline. Whereas with this, I think if organizations are operationalizing, it's been a long day, operationalizing stablecoin flows, there has to be a mandate that comes from top down, because you will have to kind of vie with internal teams to get stuff done. And if it's not coming top down, people can like play a bit of politics inside organizations and say, it's not my roadmap, it's not important. Whereas, yeah, if it comes top down, it's kind of front and center of everyone's project plans.
Yeah, I think that that also parallels something that Harpal was saying about parallel with AI as well, because we're obviously seeing a lot of use cases where AI is sort of like innovation theatre, unless it's a mandate that comes from the top down and everybody believes in it, and there's real use case and there's real ROI and sort of commercial opportunity around that. And so speaking about ROI and the sort of commercial real world opportunities, if I can go to you again, Jazz, where are you seeing the opportunities? Is it that sort of settlement efficiency equals cost reduction? Because that's a bit too simple, isn't it?
Yeah, I mean, again, to touch on a point Harper made, is like the killer app. I think the consumer facing stuff has been front of center of the stablecoin debate. It's been around, stablecoin will solve remittances. I personally don't think that is the big compelling use case. I think looking at things like B2B payments cross-border, I think that's a bigger challenge. It's also a bigger market. It's also across more payment types. Things like marketplace payments, I think that's a bigger opportunity. For example, like merchants who are on global marketplaces like eBay, Shopify, Etsy, being on that global marketplace and eBay, Etsy, all of those guys being able to actually pay out to their merchants or have finance cross region through global platforms. I think that, and also things like payroll. I think there was a deal head of crypto recently. I think that we're going to see lots more of those kind of head of crypto, head of stablecoin at those kind of organizations, because for me that's where the big opportunity is, because that's where lots of the challenges are. The settlement times are a bit longer, especially when it comes to payroll. When you do a month's worth of work and then you get paid 6 weeks after you've done the work. There's volatility in currencies cross border, and I think contractors like myself, selfish use case, contractors like myself can be stung with FX volatility, and I think that's something that can help solve those problems. But remittance, I think, it's probably the most shouted about use case, but I think it's probably the least relevant use case, especially when we come to UK, US, personally.
And from a prime perspective, Andrew, where are you seeing that your customers are either reducing risk or reducing cost or both?
I would sort of say that the application of stablecoins is becoming core infrastructure, if not core plumbing into the financial world. So I'm going to use another analogy. This one is SMS messages, right, to WhatsApp. So they both work, they both send messages, but I'm sure we've all been abroad and received a nasty surprise when we've returned from using our phone to send an SMS. And the reason for that is the proliferation of intermediaries that get in the process, other networks, etc. Looking at something like the traditional financial market, there's a lot of money that's being trapped in the system. I'm sure Harpal will agree with me on this example of FX. You do a spot trade today, you've got 2 days of counterparty risk, you've got 2 days of market risk waiting for this FX trade to settle. Blockchain inherently unlocks the technology to reduce the friction of that and move it forward. From our perspective today across our ecosystem, we support stablecoins as good collateral. We support them for trading pairs. We support them 24/7, and not all stablecoins are equal, right? Some of them should probably be called wobbly coins. It's amazing that in 2025, I'm up here with this distinguished panel talking about stablecoins after $45 billion was wiped in UST. We mentioned RLUSD Ripple stablecoin. That is a different proposition. It's one-to-one backed with cash or cash equivalents. It's NYDFS regulated. It's institutional grade. It is multi-chain. You have the transparency and proof of reserves, and was recently A-rated by an independent rating agency, Blue Chip, the only stablecoin that received that rating.
Yeah, you're absolutely right. Things have moved so quickly and evolved so fast. A couple of years ago, just to be totally honest, I was working for a firm that used to trade over Telegram of different crypto pairs and do like physical delivery. And I used to literally have to text a broker. So it was like a weird parallel to voice broking back in the day. So Harpal, I'd be really interested to know if you think that cross-border legs are genuinely more efficient, and also where your customers are utilizing your products to actually solve real-world frictions. You mentioned a few amazing examples off the record before. I'd love to hear more about that.
Yeah, love to share some other examples. So one thing I'd like to say is 0 is a beautiful number. I mean, it really is a fascinating number. 0 is nothing. No payment, nothing. When 0 gets introduced into an equation in a factor, of a pre-existing commerce value chain, it fundamentally changes everything. The example that Andrew brought up is a great one about WhatsApp, but I think more than the messaging part of WhatsApp, the really fundamental change that WhatsApp brought to the world was related to tokenization. If we think about what actually happened in the 1990s, one of the really fantastic tokenizations that took place, and again, stablecoin is just another form of tokenization, was the tokenization of voice through voice over IP. If you all, some of you, most of you are a lot younger than I am, but in the 1990s, telecom companies from respective countries, AT&T, British Telecom, France Telecom, Deutsche Telekom, NTT, these were giant monopoly, very high market cap companies because they owned the switching networks of voice. The moment voice was tokenized into voice over IP, any entrepreneur could come along and transmit voice using the public internet. What WhatsApp did that was really profound wasn't just in texting, it was in voice communication. The idea that somebody could buy an extremely inexpensive mobile device, have very inexpensive internet access, and place a call for free, for zero, from any point on the planet to another point of the planet, fundamentally changed telecommunications and wiped out all of those big telecom companies. When we introduce zero into the transmission of money, when we introduce zero into the programmability of money, when we introduce zero into the time and the cost of moving money, entrepreneurs are going to figure out totally brand new value propositions to customers that will transform various aspects of TradFi. Okay, it won't look anything like it is today. And most of what the conversation has been about is very minor changes around the edges. Oh, I can move money point to point between me and somebody I know, in large amount. All that's fine. But this is just the bubbling under the surface. What is actually starting to pop up above the surface now is new deployments that are extremely creative, very innovative, and then fundamentally disrupt the cost, the time, and the access to existing businesses. We've only applied it in one model at this point. And in order to do it, we had to build a layer one blockchain. It took us 5 years. We had to build a layer one blockchain. We had to build and launch a series of stablecoins. We had to build and launch a series of escrow, solidity-based smart contracts that managed all of these transactions. But at the end, what we now have is a virtually cost-free credit intermediation mechanism. And people ask, well, why? How could that happen? Well, what is the cost and what is the risk associated with extending credit? Two factors go into that equation. One is the volatility of the underlying asset, and the second is the time it takes for the counterpart to deliver additional margin if the value of their position has gone down. Well, in today's world, the time of delivering that additional margin is T+1, because it takes 1 day for a wire to happen. Sometimes T+2, prime broker calls at the end of the day, hey, you need to deposit more money. So given that it's volatility of the underlying asset times time to deliver additional margin equals some amount of leverage that a lender is willing to give to a borrower, what happens when you change the T+1 to T+1 day to T+1 minute or T+1 second? Well, the amount of leverage that is able to be delivered goes up significantly, which means cost of capital goes down dramatically. Access to networks and access to liquidity changes dramatically. It is a total democratization of capital markets. I think this will happen in many, many other places. This is just the first innovation, and I think lots more like this will happen. And Andrew's going to think of the next half dozen of them.
No, I agree with what Harpal said there. I think there's a lot of money that's trapped in an archaic system, and you're really allowing corporate treasurers to rotate that capital more freely.
Just if I can add there, I think the funding and liquidity point is extremely important. So at LMAX, we run a bunch of leading execution venues. So for FX, CFDs, and digital assets, and you know, the main use case for stables, you know, over the past months and years has been really that funding and liquidity management and that 24/7 ability to move essentially cash on chain. What that is now doing, though, probably over the last 6 months, is morphing into something even more significant than that, especially on our platform, and that is the stablecoin and that 24/7 nature of being able to move assets to support business models that operate over a weekend. So think, you know, crypto assets or tokenized assets. The ability to be able to move cash over the weekend on chain is extremely important. But more important is actually what we're finding from our kind of broker client base is that the demographic of underlying retail users using brokerage models are much more tech savvy, much more attuned to be able to or want to interact with blockchains or crypto assets or on-chain assets. They want to be able to move their assets between apps, whether that's a gambling app, a crypto app, an FX broker. And to be able to facilitate the movement of those stable coins into a platform like LMAX or our clients, the brokers, to then actually use that as collateral to trade multiple different products, right? So we're seeing the convergence of traditional assets, crypto assets, and stable coins being the linchpin to be able to make all of that happen. You know, and we're launching a product which enables those brokers to be able to offer wallet infrastructure plus that conversion infrastructure to deliver stable coins, do something with that stable coin on our platform, or convert it into another asset. So you know, all of that is real world. Clients are asking for that, and it's the underlying retail investors that are really driving that.
Hey, Luke, can I ask you a question? If the transmission of money was instant and free, would LMAX allow for a non-custodial wallet to transfer the funds from the customer directly into LMAX's ecosystem at time of trade, do the trade, and then have the result of that trade come immediately back to their non-custodial wallet?
The key part to that answer is if regulation allows that, right? So from us as a regulated business interacting with underlying retail investors that we haven't necessarily KYC'd, AML'd, right? So that's the big challenge, and I think that's part of there's an infrastructure blockage potentially, but also more on the regulatory side.
I agree with you. And I probably should have articulated a bit clearer. Assuming AML KYC is there, assuming it's actually your customer, assuming you know everything about them, the idea that a customer could keep their assets themselves, and again, if it's instant and free transmission of money, customers could have accounts at 100 brokers, at 100 exchanges, see the market data from all of them, and actually just send the money at the time of doing a trade with the best available price, do the exchange, and have the funds come directly back into their wallet, and no longer even keep money at an exchange. The whole issue that happened at FTX was people had money at a broker. I mean, they called themselves an exchange. They were a broker. The broker went under, and people lost their capital. This way, people could trade with everyone and not have to take the exposure of the broker.
Yeah, if your broker's holding your assets, you want to also question, why is that a necessity? What's the broker doing with those assets? Are they being used for collateral, or are they actually running a stock lending business off the back of it and rehypothecating assets? So, you know, technically at I nearly said Hidden Road, Ripple Prime, that would technically be possible. Clients don't have to hold assets with us as a PB. But what you have to factor in is obviously using blockchain. Whilst it sounds like the magic pill, blockchains get congested, blockchains get slow, particularly at times of high network traffic.
If you build your own blockchain that can do 2,500 transactions per second, be Ethereum compatible, and have a 400 millisecond block time,
XRP-L.
non-extensible.
I was going to ask you guys actually what would be the next unlock to scale, because I think we can all agree that there is regulatory clarity. There's obviously, governance controls and everything that I will come to you for in a second, Luke. But yeah, what do you think is the next unlock? I thought it was interesting, Luke, that you were saying that your customers are actually asking for this and they're driving your product strategy. So what are you hearing from them and what are you guys working on?
Yeah, I think so yes, they are asking us for this, but it's still early stages. The, the, so you say regulatory clarity again, and don't want to labor too much of this discussion on regulation, but if you look at the stablecoin bill in the US, the recent European MiCA regulations, which make it a lot clearer, the latest kind of consultation papers from the UK to really start thinking about embedding stablecoins into payment flows. It's kind of not an excuse anymore, but it's now turning into kind of a roadmap excuse. So there's definitely direction of travel from the regulators to enable institutions and firms to enter into this space. But there's still a period of implementation that needs to happen for those regulations. But what that does do is allow our clients and us to look at much more intricate models to supporting the infrastructure around stablecoins and actually making decisions to either appoint providers to help you connect at that top layer that I was talking about. So I think the movement is moving more from pilot to production because the regulatory landscape has changed and allowed us to look at it that way. But I wouldn't say that there is, there's still a long time from the regulations to be implemented, but that allows firms to probably start making decisions and start looking at their infrastructure and thinking about how they're going to implement it.
Harpal, I was going to ask you about broker adoption and whether price discovery still feels too siloed. I mean, obviously, perhaps not for your product, but yourself and Ripple are kind of like the unicorns in the industry. There's not really a lot of mature operators in this space. So where do you see the friction points for brokers?
For brokers adopting stablecoins. So first of all, we're mostly involved in stablecoins on the crypto side. And its two initial use cases were first in settlement of the settlement currency of crypto itself. And the second was in terms of some of these, collateral mechanisms. I think on the crypto broker side, they have no problem with it. In fact, many of their businesses rely on the use of stablecoins. Tether's primary use case is as the settlement version of US dollar for all the major crypto exchanges that are out there. Most BTC trades against USDT rather than USD. So I think in the FX space, it's a totally different problem domain. I think as either technology companies or partners or infrastructure providers give brokers a reason to use the stable coin, that somehow it enhances their business, their profitability, lowers their risk, gives them access to additional liquidity, they will just use it. I don't actually think they have that much problems with it. I think brokers, again, because they're a bit more risk-taking than banks and a little less regulated and their capital requirements are monitored and measured in a different way, brokers actually will adopt this, but people have to give them reasons to do it. I think on the bank side, it was a totally different story prior to this, the change in regulation that just came out. Up until, maybe 4 months ago, US banks had to keep 2x the amount of stablecoins they were issuing in cash on their balance sheet. And it was just prohibitive. That's all changed. But I actually think brokers will adopt it as soon as they're given a reason to.
And I just wanted to give you the last word on that, Andrew, if you think there is any other unlocks.
Yeah, I think looking at the total value that's in stablecoins today, right, 300 billion, That's not insignificant. That's double the amount that it was this time last year, and we would expect that to grow into the trillions. I actually saw a post yesterday that over the course of the year, $50 trillion of value has been transacted through stablecoins. Just to put that into context, that's more than Visa and MasterCard combined. So I definitely think we're going to see, the increasing adoption. If you look at trading that happens on the centralized exchanges, a lot of that is against stable coins. On the decentralized exchanges, nearly all of it is against stablecoin or stablecoin-like products because fiat can't interact with DeFi. The Genius Act that I think we've touched upon is certainly going to add more legitimacy to stable coins and reduce risks. And from an overall digital asset perspective, it's quite different to traditional finance in that it is quite retail driven. It's been a kind of a retail up product. So apologies if anyone's in the room from Travelex. But if you want to send, a Mexican wants to send $100 to Australia, you use Travelex. There's a lot of friction there. There's a lot of time delay, and maybe $80 worth arrives at the other end. You can use a stablecoin sandwich today. You convert your peso into RLUSD. You put it on the RXPL ledger. It moves within seconds and at fractions of a cent of cost, and it arrives at its destination where you can then, off-ramp that by selling RLUSD into Aussie dollars. So I think that, I think the, stable coins are definitely here to stay. The infrastructure around what I just described, though, definitely needs work. On-off ramping is definitely, I think, in my view, an area that needs focus. We've also touched upon this. It wasn't that long ago you had a very hostile environment in the SEC. Operation Choke Point 2.0, people were being debanked from participating in this sort of nascent ecosystem.
So I promised that I would leave a couple of minutes for questions if anyone is feeling brave in the audience. I will.
Do I have to mention my name? Yes, I represent Parthenon and LGA. We deal with a lot of banks and fintechs, etc., etc. This is more of a generic question. It's wonderful, isn't it? We're all talking about stablecoin. We're all talking about crypto versus fiat. The fact is, from the people I'm speaking to, and that includes very senior C-level people, there's a terrible, terrible lack of understanding about the industry. You are all experts, and probably people in this room. The impression we get is that government, central banks, the regulatory authorities don't want the significant population to understand it, because in the decentralized environment, in the cold storage world, the government and the regulator and the central bank has no control. And if you have no control over your currency, you have no control over your economy. So I don't want to get into the politics of it, but the fact is, if the industry is to grow, and I'm sure it will, there needs to be certain challenges, and the biggest challenge is education. And senior people in the corporate world have no understanding. They understand syndications, they understand capital markets, that's what they do. They do not have the opportunity to take on the crypto world. Why? Because of the risk, because of shareholders' activities and how they feel, and basically the lack of understanding given by the government, the regulatory authorities, and the central banks. So, how do you meet that challenge, please?
I'll sort of try and address part of that. I think one of the things you need to think about, I guess, with stable coins is that many of these can offer yield or rewards to the end user. So if you're in the United States and you have a bank account, a checking account, those things pay next to zero interest. So you can imagine if there was a wholesale movement from people emptying their checking accounts in the United States and going into an on-chain yield-bearing stablecoin. That's probably part of the reason for, I guess, some of the mystique, is it's not necessarily in certain interest groups' realm to really propagate and promote the use of stablecoins as a value of storage. So very much, things like the Genius Act, which prevent yield-bearing stablecoins are there to make it more a method of remittance. But yeah, to directly address your point, I think there are a lot of groups, Crypto UK, Stand with Crypto, for example, that are working with various regulations to increase understanding and adoption of governments.
If you give the consumer a reason to use something, they will use it. I don't think the rickshaw driver in India knows anything about VoIP when they're picking up their phone on Android with a Reliance ISP connection and calling their relative in Dubai for free. They just know it's free. Stablecoins and the creative applications on top of them, when they are delivered to the population, will deliver so much value, so many interesting new ways of them managing their money, paying for things, micropayments. That will give them so much more utility. They will use it, and governments won't be able to stop it, number one. Number two, governments like stablecoins, and they like digital tracking on public ledgers of how people are spending money. It is how they see where everything is going, and they don't need banks as their deputized regulators to be tracking where all the money is and do all of their reporting. The governments can go directly to the chains to see that, which is why, for example, China is so enthusiastic about a central bank stablecoin or digitally issued currency, whereas in the US, the Federal Reserve will never do that because of privacy reasons. So I think governments actually will support this. I think users will adopt it. And we as individuals should actually think about the privacy implications ourselves. And actually, even though I'm a technology company, I'm advocating for this. I think as individuals, we should think about the privacy issues and protect ourselves to have some level of opaqueness when we are using these digital versions of currency.
Yeah, I think corporates and TradFi are the next wave of adoption into stablecoins. But in order to make that a success, they're going to need trusted intermediaries in a format they're used to. That's where I think prime brokerage comes into place. So I think we see the continued separation of church and state. Picking on FTX as the example, you had a retail exchange that had an internal market maker trading against you. They custodied your assets. They gave lines of credit to users. They rehypothecated assets. And as we saw, that was not a good outcome. So I think we're going to see a continued separation. Matching engines are there for providing matching services. Market makers for efficient risk transfer. Credit intermediaries and prime brokers are there to provide that service. And then you have custodians that do just that. They provide custody services.
Just a very quick one. I think your point on education is very important, but I think it's about building trust in the ecosystem. For example, most people don't know how a card payment really works. Like, there are very few people who know the end-to-end of a card payment, who the players are, but I think the players that are in that ecosystem are trusted organizations. Same with, and again, to Harpal's point, it's about building compelling use cases for consumers, in my opinion. And once those consumer use cases are so compelling, I think the governments are not going to be able to shy away from kind of leaning into those use cases. And again, Apple Pay, for example, is another case where people don't really know how cards are tokenized using those third-party players, but people use it on a daily basis. Most people have probably come here, double tapped, touched on an Oyster. They trust that Apple, Visa, MasterCard are securely tokenizing their information, but they don't necessarily know how it works. So education is important, but I think trust is even more important.
Just a quick point from me. So at LMAX, we service the top 40 banks in the world. They trade FX on our platform, have done for many, many years. What we're actually seeing from the banks is actually with the regulations, as I was talking about earlier, becoming a little bit clearer. They're actually now starting to think about their own infrastructure, about how they support any digital asset, right? So it's not necessarily a stablecoin problem on the education, it's a digital asset problem, right? Whether it's a tokenized money market fund, tokenized equity, a stablecoin, a deposit token, they're also coming up the curve quite heavily on the infrastructure that supports that. So we are now starting to see those banks moving into that digital space, and we'll start to see them trading on our platform, next year. So it is coming, but the education problem, it also is within the banks, I would say.
Just want to say thank you so much to our wonderful panel. Thank you for being so open and candid and for the intelligent discussion. I can see the red flashing, so we have to vacate the stage. And thank you so much for listening, everyone.